Hi, Gary Merzinski here, and we're going to wrap up Chapter 5 by talking about the income approach to measuring gross domestic product. We just looked at the expenditures approach. That's measuring all the dollars spent in product markets to purchase all the goods and services that were produced. Now we're going to look at all the income that was paid to everyone that played a role in producing the goods and services, all the different forms of income. If you total up all those dollars, that should give you a gross domestic product too. This picture shows you on the left the expenditures approach, measuring all the dollars spent in product markets, and on the right side, all the dollars spent in factor markets. This is businesses paying for the resources they need to produce the goods and services. The biggest part of this is wages. This is compensation paid to employees of companies. And then profits, this is the part of a company's revenue that gets returned to the owners of the business in return for their investment in the business and their ownership equity. And then interest, this is income that goes to financial institutions who have made loans to businesses, and then rent for any capital resources that are rented by businesses. Someone gets that form of income. So these are just different types of income. But we're going to look at the overall now national income, all the income earned in the economy in a year. But first, here's an important quantity: net domestic product. Net domestic product is when you take gross domestic product and subtract depreciation. So we need to explain what depreciation is. Those of you that are accounting majors know what this is, right? This is an expense that accounts for the fact that some of a business's capital wears out or becomes obsolete during the year and therefore is reduced in value. So that becomes an expense. And so net domestic product then is if you take GDP and subtract the depreciation of all of the capital goods in our economy. And if you recall from Chapter 2, I believe it was, you saw a number. It was someone's estimate of the value of all of the capital in the U.S. economy, $80 trillion. So some portion of that $80 trillion wears out each year or becomes obsolete. And the capital that is computer-based, those capital resources, those investment goods, become obsolete before they wear out, don't they? And have to be replaced. So anyway, this is just an estimate of that expense, depreciation expense. In our GDP equation, using the expenditures approach, you recall we had C for consumption, plus I for gross investment, plus G for government expenditures, plus net exports. So gross investment is the total amount of money spent by businesses and governments, who also own capital, to purchase new capital. Spending on capital. So this is spending on capital goods because some of it wears out during the year, some of it becomes obsolete. So this could be a business paying to modernize the facility, could be paying to expand the facility. Well, across the whole economy, money is spent on investment goods, on capital goods, and that's gross investment. That's the total amount spent during the year by all business and all organizations. Net investment then is if you take gross investment, the amount that was spent, and subtract this estimate of the capital goods that wore out or became obsolete during the year. So if you would want to at least be replacing those capital goods, right? The capital goods that wore out or became obsolete. If you're investing in new capital goods at exactly that rate, then net investment would be zero, right? It would be even better if you're spending more on your capital goods than the value of the capital goods that wore out or became obsolete during the year. Then you are increasing the value of your capital goods. If you did that, net investment would be positive. And this is measuring across the whole economy. So collectively, all the businesses and organizations that own capital, this is measuring how much new capital they're spending on above and beyond that which is wearing out. So net investment would be a positive number if they're spending more on new capital goods than what wore out or became obsolete. And here's a further explanation of depreciation. But what we're doing now is we are trying to come up with a number that represents total amount of income earned in the economy by businesses, by any other organizations, including governments, and by individuals. That quantity will be national income. It's a little bit different number than gross domestic product. There's two adjustments we have to make. First is depreciation. Again, this is an estimate of the value of the capital resources that wore out during the year or became obsolete and therefore should be replaced. That is considered an expense. So that's actually going to be deducted from GDP. And net foreign factor income, because this is the income approach and not the expenditures approach, there's another adjustment that has to be made to GDP to get national income. And that is you want all of the income earned by U.S. citizens to be included in national income. Some of it is earned outside of our economy. Some of it might be earned in Canada. Similarly, some income that's earned within our economy is earned by foreigners. You want to subtract that. So you want to add in any income earned by U.S. citizens outside of our economy. You want to add that to get national income, and you want to subtract any income earned within our economy by foreigners, because that income is leaving our economy because they still live somewhere else and are citizens of some other country. It also works this way for factors of production, like capital. So because some of that income leaves our economy too, right? So if there was a Ford plant in Mexico, for example, the profit portion of the income earned at that Ford plant in Mexico comes out of the Mexican economy into our economy. That becomes income for Americans. And if there were a Toyota plant in Kentucky that's earning lots of income within our economy, the profits portion of that flow out of our economy to Japan, where the owners are, and so that should be subtracted. So this net foreign factor income is making that adjustment to GDP to get national income. So this kind of sums it all up. And I'm going to ask you to put a star next to this slide on your handout, because when you're doing the problems, you're going to see a problem that's asking you questions and giving you some quantities, and you have to figure out what national income is. These two equations are how you're going to do that. And here's a hint. It's problem number 4 at the end of the chapter. All right, so first you'll need net domestic product. And again, that's gross domestic product minus depreciation. Then national income will be net domestic product plus net foreign factor income, this adjustment. Or you can really combine these into the same formula. If you did, then national income would be GDP minus depreciation plus net foreign factor income. Now that we have national income, let's figure out what portion of national income was earned by individuals, by persons, personal income. There's an adjustment we have to make to national income to get personal income, because some of national income is the income of corporations or is the income of governments. The rest would be personal income. So here are some of the adjustments we have to make. Some get subtracted from national income and some get added. What gets subtracted from national income is indirect business taxes, like sales taxes. That's the biggest part of this. So because that's income for governments, right? Not persons. And then corporate profits. So the total amount of profit that a company earns is divided 3 ways. First, some of that profit gets returned to the owners of the business. And if it's a large publicly traded company where shares of stock are traded and individuals own shares of stock, you're part owner, profit distributions going to shareholders are capital income, and any other payment of profits to the owners of the business are considered capital income. That actually should be counted, right, as personal income. So that gets added to GDP. So that's the first part of profit that a company earns. Some of it gets returned to the owners. The rest of it is corporate profits, which are taxed. Corporate profits are the remainder of the profits that are not distributed to the owners, that are retained by the corporation for their use maybe in the next year. All right, so corporate profits are taxed. By the way, we just lowered the corporate tax rate by a good amount, and this was in 2017. So this was the Trump administration, part of his platform when he ran for president, Donald Trump, was that he was going to lower the corporate tax rate. Our tax rate was higher than other similar economies in Western Europe, for example. So we lowered it in 2017 as part of the tax cut package, and we dropped it from 35% to 21%. So that's a significant decrease because corporate profits make up 10% of all national income, and national income is taxed by the government. So that's a 40% decrease in the tax rate on that 10% of national income. So that was a big decrease in revenue for the federal government. So corporate profits are what's retained, that part of profits that are retained by the company and not paid to the owners, and some of that then gets paid in taxes to the government. So this should be subtracted from national income to get personal income, and only the capital income portion should count in personal income. And then payroll taxes and transfers. Remember, with the expenditures approach, if we found GDP using the expenditures approach and we got national income from GDP following the process we just explained, then we have to then count public transfer payments because they're not counted in GDP measured the expenditure approach way, right? So this really is income for individuals, for people. And Social Security, for example. Social Security tax is not income for people. It's income for governments, the federal government in this case. But Social Security benefit payments should count as income. So this gets added as to get personal income. And any other kind of transfer payment that works that way. Unemployment insurance, for example, people pay an unemployment insurance tax. That should be deducted to get personal income because that becomes income for the government, more or less, to fund these benefit programs. But then those that are paid the benefits, unemployment benefits, that should be counted as personal income. And then net capital income, as I mentioned, this does count in personal income. So this should be added to national income to get personal income, because this really is income for individuals. And this is, again, that portion of corporate profits that are paid to individuals that are the owner of the business or shareholders of the business. And here's a summary of how we get from national income to personal income. We subtract indirect business taxes. We subtract corporate profits because that's the portion of business profits that are retained by the company. Some of that paid to the government as taxes. We subtract interest and miscellaneous payments. We subtract Social Security taxes and other payroll taxes because that becomes revenue for a government, not for individuals. And then we add public transfer payments like Social Security or unemployment benefits. And then we add capital income because that is compensating the owners of a business or shareholders for their ownership equity. Now that we have personal income, the total amount of income in the economy earned by individuals, let's figure out how to find disposable income. Disposable income is simply the money that individuals have left over after paying personal income taxes to spend. They then spend this money on both necessities and discretionary purchases, right? This is everything you have left to spend. Your take-home pay, right? After personal taxes have been deducted from your paycheck. This is your disposable income. So there's a total amount of disposable income across the whole economy in a year. That then gets divided into consumption and saving. And we're going to look at saving rates a little bit later on in this course, because that becomes important to fiscal policy. So some of your disposable income you use for consumption. That's everything you spend on consumption items, consumer goods and services. And then the remainder you save. And this is just a diagram which kind of shows you how this works. So you have personal income, you have personal taxes which go to governments, the remainder is disposable income, which is divided into consumption and savings. This is an interesting table. This shows you the journey we just went on to start with GDP, and then to get national income from that, and then to get personal income from that. And so this was for the year 2019. So, the point of this is we say that there's two ways to measure GDP, the income approach and the expenditures approach. Well, GDP measured in the expenditures approach in 2019 was $21.4 trillion, or 21,000 billions. And as we saw, to convert that to net domestic product, you subtract depreciation. Total amount of depreciation across our economy was 3,463, and that's because businesses consider depreciation to be an expense, kind of like a negative income. So you take that out of GDP on the way to national income. But then you add in net foreign factor income. So this is income earned outside of the United States by Americans, but then subtracting income earned inside the United States by foreigners. That's that adjustment, net foreign factor income. Now, statistical discrepancy, I'll explain that on the next slide. You're going to love this. So just ignore that for the moment. All right, so you have GDP, you subtract depreciation, you add net foreign factor income, that gives you national income, the total amount of income earned in our economy within our borders. Now, to go from national income to personal income, you're going to subtract out income earned by organizations other than people, so businesses and governments. And so what does that mean? Well, you're going to subtract indirect business taxes. You're going to subtract corporate profits. That's not income for people. You're going to subtract interest and miscellaneous payments, Social Security taxes. That's income for governments, not people. So you take that out. Then you add in transfer payments, because that was not measured in GDP, if you remember, the expenditures approach. We did not count public transfer payments because nothing was produced when someone received their Social Security check. But it is income. That's why you have to add it in at that point. So you're going to add in transfer payments. That is income for people. You have to add in capital income. That is, most of it is people that own shares of stock are paid a dividend. The profits are shared with the owners of the business, the shareholders. That becomes a form of income for people. So that gets added in. And then you end up with personal income. If you want to know what disposable income is, you just subtract personal taxes, and that's the money that people have left to dispose of. So these are numbers that are measured, and people would want to know what these are every year. They're measured every month, actually. All right, so you have gross domestic product. Then you have national income, which is a portion of GDP. And that's income earned by all businesses, governments, all organizations, and people. Well, if you want to know how much income was earned by people, you subtract out the income that was earned by governments and by businesses and other organizations. And then you end up with a smaller number, and that's personal income. So there are two methods for measuring GDP. The expenditures approach, that's on the left, and the income approach on the right. The expenditures approach is where you total up the dollars that were spent to purchase all the goods and services that were produced in the economy in a year. The income approach is where you total up all of the dollars paid to people as some form of income. And then you should end up with the same number, because if you remember the circular flow diagram, On the left, the expenditures approach, that's measuring all the dollars spent in product markets. On the right, the income approach, that's measuring all the dollars spent in resource markets or factors markets. You should end up with the same number. Let me direct your attention to the income column on the right, the last category, statistical discrepancy. Now all this is a fudge factor. They actually do not equal each other, these two approaches. And let me just say this, it's very difficult to precisely measure all of what's produced in our economy in a year. They do the best they can, and then they estimate the rest. Let's see how close they came. That is just the amount of error there was. So, for example, it looks like, and these are in billions, there was $120 billion missing when they measured income at the end of the year. How do you feel about that? Suppose you're the president of the United States, and your staff comes to you and says, sir, ma'am, there's $120 billion missing. We just measured total income earned in our economy last year. Are heads going to roll? Are people losing their jobs over this? Are people getting fired? Well, let's put this in perspective. Pull out your calculator. I'm going to do this right now. All right, so let's see what percentage of total income that would be. So that would be 120 divided by 21,427. It looks like I get 0.0056. So that would be 0.56%. So that would be about half of 1%. That was how much they were off. I think this year no one's going to lose their job. I'm going to keep an eye on this, though, and see if they can do better next year. Now let's think about the flow of income. You can almost think of the circular flow diagram as you're looking at this. Well, income flows out of GDP to households in the form of disposable income, which they then use to purchase products in product markets, right? That's returned to GDP then as consumer spending. GDP income is derived from GDP to businesses in the form of retained earnings. This would be corporate profits. And depreciation allowances, because they consider that an expense. And then that's returned to GDP as business investment spending. That's big I sub G, right? Investment goods. And then some of it's returned to the government in the form of taxes. That's their income. That then gets returned to product markets in the form of government spending, because the income, the expenditures the government makes, eventually end up as income for government employees, which then gets spent in product markets. And some of what the government purchases, they purchase in product markets. Commercial off-the-shelf equipment, for example. This diagram, now this may confuse you more than it helps you, so if you don't get this, I wouldn't worry about it. It's taking the information on the previous slide and trying to show you how the government, the circular flow diagram, which we've seen a few times before, shows how individuals, households, consumers interact with businesses in the economy, and you have a flow of dollars in one direction. It could be income for households, it could be revenue for businesses, and then you have flow of products and resources in the other direction. Well, you have government in the center there, because they are pulling some money out of the economy and putting other money back into the economy. So that's what these arrows at the lower left are showing you. Indirect business taxes, that takes money out of the economy, goes to the government. Social Security taxes comes out of the economy. Corporate taxes, same thing. Net interest goes into the economy. Transfer payments like Social Security, welfare, unemployment compensation goes into the economy from the government. And then personal taxes is another example of money coming out of the economy. So that's how the government interacts in the circular flow model. And the last thing we'll talk about in this chapter, we've already hinted at this. GDP per capita is the best measure we have to represent quality of life, but it's not perfect because it doesn't measure everything that's important to quality of life. One of them, for example, is the quality of the environment. You wouldn't know just looking at GDP or GDP per capita how clean the environment is in a given economy, because if we had no environmental regulation laws, for example, we could be producing lots more GDP. Now, we make that trade because we think that the quality of the environment is important. How about the underground economy? This is anything that's not being measured in GDP. Improved product quality, which is something that has happened over the years. Yes, GDP per capita has gone up in our economy since 1950, about 2% per year on average, but that's undercounting the improvement in our quality of life because improved product quality is not included in there. Leisure. There are European countries which have a much lower GDP per capita, but they have much more leisure time. That's the reason. The average person is working a lot fewer hours, whereas we're working 1,800 hours on average per year. In France, they're working 1,450 hours per year. So that means they have much more time for leisure activities. And that's it for Chapter 5. I'll see you in Chapter 6. If GDP per capita is the best reflection of standard of living, quality of life that we have, then if you have a high GDP per capita, does that mean your people are happy in your economy? Not necessarily, because happiness is measured. There's actually several measures of how happy people are, and you can see this ranking shows the Nordic countries. Why are they so happy? What's there to be happy about? It can't be the climate. Finland, Denmark, Norway, the Netherlands, and also Iceland. They all have GDP per capita that's lower than us. We're number 19 in terms of how happy our people are. So I guess money's not everything. There are those other factors, like leisure time. Everyone higher up on the list, except maybe not Canada, I'm not sure, but 1 through 5, they all get more vacation time, more work-life balance. So, and it's a cultural thing. They just think that the work week should be 35 hours a week, not 40 hours a week, the standard work week. And we believe that you should have a month off for vacation in the summer, more time to spend with your family. Even, to sacrifice GDP, and you're going to be sacrificing income in order to do that. But it's just a different values placed on work-life balance in some other countries as compared to the United States. But we have more stuff, right?